Let's set the scene. The date is January 20th, 2026. You look at the financial terminals, and they show silver at a strong $94 an ounce. On the surface, the market looks calm, even robust. But here's what you need to understand. That price is a ghost. It's a lagging indicator for a crisis that has already happened. The real signal isn't on the screen. It's buried deep in the plumbing of the physical market.
So if you're holding cash, maybe a standard 60-40 portfolio, this number, $10,000, is a direct measure of your exposure to a structural failure that's ripping through the precious metals market. It's the new minimum order at the country's largest bullion dealer, and it's a signal that for most people, the exit doors have just been locked. We're going to break down the framework you need to navigate what's coming next.
You see, most investors are making a critical mistake. They see that $94 price, and they assume everything's fine. There's liquidity, there's strength. But they're looking at the paper price, and that's just an electronic promise, a digital number on a screen. It's rapidly, and I mean rapidly, disconnecting from physical reality. Meanwhile, the physical market itself, through its biggest dealers, is screaming a warning, a catastrophic 50% collapse in their ability to produce the very product they sell.
And this condition, well, this is what we call a Janus market. It's named after the two-faced Roman god because you have the paper price looking one way and physical reality looking in the complete opposite direction. Look, this isn't a price correction. It's not a dip. It's the system literally splitting in two. And understanding that is the absolute first step to preserving your capital.
All right, to really get a handle on the risk here, we have to diagnose exactly how this thing broke. Think of this as an autopsy of a modern market. Let's start with Pillar 1, the fracture of the physical supply chain.
Think about how silver gets from a mine into your hands. It's basically a four-step journey. Now, the whole system hinges on step 3. This is the critical choke point, converting those huge 1,000-ounce good delivery bars that institutions trade into silver grain. That grain is the essential raw feedstock for every single retail coin and small bar. Without grain, the mints simply stop producing.
Now, don't take my word for it. This isn't some theory. The CEO of the largest U.S. retailer, Ken Lewis, stated it himself in plain English. This isn't a demand problem where they're just swamped with orders. This is a supply chain heart attack. They cannot get the raw material, the feedstock, to mint new products. The system is being starved. And if you needed any more proof, here it is. The same retailer canceled all pre-sales beyond 30 days. Now, in the world of logistics, refusing to take someone's money for a delivery that's just 31 days away is the ultimate distress signal. It means you have zero visibility. It means your suppliers have stopped answering the phone. So here's what this means if you're managing a real capital. Your biggest risk has just shifted. It's no longer about price. It's about access. Can you even get it?
Now, a failure this big doesn't just happen by accident. It wasn't a random event, and that brings us to our second pillar. This mechanical failure was the direct result of intentional, strategic moves made by major global players. You have to understand there were 3 primary actors at play here. First, bullion banks tried to slam the price down during a low liquidity holiday week to cover their massive short positions. Second, the White House used targeted tariffs in a play for Greenland, basically signaling that the US dollar is now a tool for territorial acquisition. And third, China simply reclassified silver as a strategic material, effectively padlocking its domestic supply from the rest of the world.
And look how fast this all went down. It was brutal. The bank's price suppression maneuver completely backfired when automated pension fund algorithms saw a bargain and bought the dip, trapping the banks. Then China's move choked off refinery supply. And finally, the Greenland gambit spooked sovereign wealth funds, causing them to dump dollars for physical assets. A cascade of strategic moves broke the global market in less than 3 weeks. The takeaway? The game has changed. Your classic counterparty risk has been completely overshadowed by raw geopolitical risk.
Okay, So let's dig deeper. To really see what's going on, you have to ignore that headline price. You have to look at the data points that the mainstream financial media is completely and utterly missing. Just look at this, a $9 gap between the Western paper price and the physical price over in Shanghai. In any normal functioning market, that gap is free money. Arbitrageurs would close it in minutes, literally seconds.
So that leads to the obvious multi-billion-dollar question. If this is free money, why is nobody taking it? The answer is simple and terrifying, because the metal can't move. The bars sitting in London vaults are either claimed multiple times over, or they're trapped by China's new capital controls. It's like a roach motel for silver. It checks in, but it doesn't check out. And this, right here, is definitive proof that a single global price for silver, it just doesn't exist anymore.
But if you're looking for the real smoking gun, this is it. The lease rate, the cost for big institutions to get their hands on physical silver for immediate delivery, has spiked to 8%. You have to understand, this rate is almost always near zero. An 8% rate isn't just high, it's a 5-alarm fire. It's the market screaming, absolutely screaming, for physical metal right now. That is a level of institutional desperation you will never, ever hear about on the evening news. All right, so we've looked at how the market broke and who broke it. Now, let's pivot from diagnosis to strategy. This is the framework for how to position yourself in a market that is fundamentally fractured. First things first, you have to separate the idea of price from the reality of access. That $94 price on the screen is a complete illusion if you can't actually get your hands on the metal. Second, prioritize physical possession over any and all paper claims. Third, you have to find ways to bypass the big retail choke points. They are clearly compromised. Fourth, focus on fractional and what's called constitutional silver, older silver coinage, because those are likely to be the most liquid and trusted in a chaotic environment. And finally, you have to systematically exit any asset that carries counterparty risk, because in a true crisis, all those paper promises will be settled in a collapsing currency, not with physical metal.
So let's boil it all down to one core concept. The market has split in two. The game is no longer about predicting the paper price. The only thing that matters now is securing access to the physical asset before that gap between the two worlds becomes a chasm you can't cross. This isn't a prediction, it's a positioning framework.
Before we wrap up, remember, the financial landscape is constantly shifting. The insights we've shared here today are for educational purposes only. They don't constitute financial, investment, or legal advice. Every investor situation is unique, and you should always consult with a certified professional before making any major decisions. Our goal is to help you identify the signal, but the final move is always yours. Stay sovereign, stay informed.